Excited to have you in here. Please um, ask as many questions as that. Normally, these particular classes are not heavily attended due to their complexity, and they're not, the activity in here is not great, which is fine for us. Matt and I can talk about these things at length and for a long while. Certainly can fill an hour, but it's always better when the conversation is at the very least a little bit two-sided. Matt, how are you doing today?
Doing well, and I agree. This is a topic I think it's intimidating, right? Even the title of it is synthetic option, right? It has this kind of mysteriousness to it. It's really, at the end of the day, it's not that complicated, right? It breaks down to call put parity and being able to use both sides of the chain to effectively represent one position in a different way, and that's what Constantine's going to show us right now. So that's the basic idea behind this. The main thing that I just kind of want to get people to start thinking about before we jump into some of the specifics, which is, well, why does this even matter, right? Why does it matter that we can do a synthetic long call versus a regular long call? And the answer is kind of twofold. It's probably less important than it used to be when commissions mattered a lot more, but it's still one of those things that when you look at potential per contract amount of trades, and if you're doing a lot of them, it could come in handy to be able to transform a position by adding or subtracting a call or a put option rather than taking off a whole trade and putting a whole one back on. So that's one thing, but really it's the idea, I think, of just fully understanding what's the actual underlying pinning idea behind why options are priced or why they're priced. And I think understanding this allows you to get a fuller grasp on just kind of the basic underpinnings of what an option even is, right? So that's kind of the way I always like to start off this class. That being said, I do want to jump right into call put parity because it's the the idea that kind of allows us to
Started combining them. Now, a lot of people, we kind of lose a lot of people, a lot of new traders and investors right here. But the truth of the matter is, folks, is if you flip or you flip this A4 formatted piece of paper in half, you would realize that each one of these positions is essentially the mirror image of the other. And this is a very important key point to remember that for every transaction to be another side to that trade that is effectively doing the opposite of what you're doing. In order for one share to trade in the market, someone needs to be a buyer and someone needs to be a seller. Now, the seller doesn't necessarily have to be a short seller, but there needs to be a seller. In other words, someone who already had that share who is selling it to you. So in order for one share to trade, there needs to be one buyer and one seller. The same is true for calls and puts. For every call bought, there needs to be a call sold. And for every put bought, there needs to be a put sold. If you understand that dynamic from the very start or your beginning, um, or during your beginner's learning of how options work or how capital markets work in the United States, if you understand one side or one of these trades, you automatically understand the other. Why? Because if I am buying a long call and I understand how I make money and how I lose money, you 100% in the vacuum understand what the other side of that trade is. So if you're a buyer of a call, the seller of a call has the exact opposite P&L diagram of yours, and vice versa. So again, truly, if you understand any three of these things, regardless, long or short, like if that comes naturally to you, right? If the long side of the equation is the simplest thing that kind of comes naturally to you and you understand it, just think of the opposite side of that spectrum or that equation, and you will understand what the other side is like from the P&L perspective. So it's not like we're reinventing strategies here, okay? We're just looking and thinking about them in a myriad of ways through some simple algebraic equations. All right, very good. So now we're going to look at the Greeks of synthetic components. So this is more of an intermediate type of an idea, right? Certainly not the most advanced because we're not talking about second order Greeks, but an intermediate thought. You want to take a screenshot of this slide just to come back and reference that as we're thinking through different types of structures and parameters. But the idea here is that, folks, if you are long a stock, you know that when it goes up, you make money, and when it goes down, you lose. So that means that you have positive delta. You have positive delta in a lot of things in your life, right? Positive delta in your jobs. You have positive delta in your home equity. You have positive delta in your risk assets. Pretty much, this should come naturally to an American. The short side of the equation, the short stock, is negative delta. Why? Because if you're short stock and the stock goes down, you make money. And if it goes up, you lose. So it's the opposite side of the long stock. And the stock ownership in and of itself is delta, right? So if I own 100 shares long, I'm long 100 delta. And if I am short 100 shares of stock, I am short 100 delta. If stock goes up on a long stock position that I own 100 shares of, I'll make $100. It goes down $1, I lose $100. That's very simple to understand. Now we are going to go through the complexities of individual call and put legs. And what we're going to try to do throughout the presentation today is effectively use two of the components to create another. Again, we might be losing some of you at the moment, but please stick with us because this is a very, very key concept to understand. You would notice that long option positions share some signage. They share signage for gamma, theta, and vega. Short option positions share signage for gamma, theta, and vega. This is going to be a key component to understand when we're starting to combine things. What are we doing? We're either trying to eliminate option-centric risk or add option-centric risk to create something else. So again, put call parity, let's go through it. In an environment where money costs money, calls are always going to be more expensive than puts. In an environment or in an underlying security where dividends are large, maybe they are weekly, maybe they're monthly. For most underlyings, they're going to be quarterly. The larger the dividend amount, the cheaper on a relative basis the call is going to be versus a put. Okay, so these things are just some things that you have to write down on a sticky note and remember. Now, all we're doing is deploying a very simple algebraic equation right? Process of elimination to come up with the other side. All right, so I'm gonna tune away from the presentation deck as much as I possibly can, Matt, and I'll talk about long and short stocks, sir, and I'll leave the more complex stuff to you for the back end. But look, we have two profit and loss diagrams on the left-hand side. We combine the two of them to come up with a third. Let's think this through together. Long stock, I have no option-centric risk. If the stock goes up, I make money. If it goes down, I lose money. I have calls and puts, and I can combine them together to create a synthetic long stock exposure. So let's think about it. If the stock goes up, I make money, and the amount of money I can make is unlimited. X time frame constraints, right? Because stocks don't have an upside cap on them. If the stock goes down, however, I do have a maximum potential loss that is equal to the capital committed to the trade, right? Meaning if I'm not trading on leverage, I can only see that stock go to zero. It will never go negative. So I have a limited amount of risk all the way down to zero in a company going bankrupt, and I have unlimited amount of upside potential. So let's think this through from an options perspective or option standpoint of view. What gives us an unlimited upside potential? A call option does, doesn't it? If I'm buying a call option, I have a limited amount of risk to the amount paid for the call, the initial debit. So if the stock doesn't go anywhere, goes sideways, goes a little bit higher, or goes lower, substantially lower especially so, I lose money on the call. How much can I lose? I can lose only the amount I paid for it. However, I can make an unlimited amount without a time constraint, right? So the further the stock goes, the more money I potentially stand to make. In fact, the more vicious the move higher, the more momentous, the more trending, the more volatile, the better it is for me as a call owner. Now, okay, that's great. So I have capped downside risk. That's why there is a horizontal line below the T there, below the zero axis, or the below my X axis, right? Starting below the zero line effectively. And I have unlimited upside potential, but I have to pay money out of pocket in order to gain that upside potential and have limited risk. So what could I do in the options world in order to offset my initial commitment in terms of a debit, so I'm not gaining additional cost basis, cost, if you will, right? But also, I want to open myself up to downside risk. So what could I do here? I can sell a short put and short a put, preferably for a truly synthetic option at the same strike. And I'm going to use the put proceeds to pay for the call that I'm buying. What does that do? Well, it just eliminated the additional cost on top of the current at the money cost basis that I would be paying by just simply buying stock. It eliminated my initial debit, right? So it reduced that. It made that cost zero. But it opened me up to downside risk in a stock all the way down to zero. It's not unlimited. It's capped, but it opened me up to that risk. So it's a combination of these two strategies stacked on top of each other. Now, the slide is basically telling us, well, uh, different strikes could be used. And that is absolutely true. But in order for it to be a truly kind of synthetic long from the onset, in order for you to say, if the stock is trading at $50 right now, how could I create a synthetic long stock at $50 a share? You would be looking at an at the money $50 long call and an at the money $50 short put. Okay. Now, Matt, here is taking it into gear. How many of you in the audience are comfortable with shorting stock? Have you ever shorted stock? So a few hands going up. By the way, NG, I see your comment in here. Someone mentioned like be prepared for some, for some silly questions. There are no silly questions, right? This is a complicated matter, and ask away by all means. But the short stock equation, which most people are not comfortable with, is the exact opposite of what we just discussed with the long stock position. Just think this through for a moment, right? If we use options for convexity, for optionality, for efficient cost of capital. We want to use as small of an amount of money as possible to gain exposure to the underlying security. How can we efficiently and effectively gain exposure to an underlying security that I'm bullish on for substantially less amount of capital commitment than I would need in order to buy a stock? Let's say a stock is trading at $400 a share. Okay, I need $40,000 to buy 100 shares of stock. Who in the world would use a synthetic long stock position? Somebody who is thinking about a particular time frame to be bullish for, understanding that the risk reward is going to be identical to buying long stock, but someone who is willing or is looking for capital efficiency, right? Now, some of you are probably scratching your head. Why in the world am I trading long stock? Why wouldn't everybody be doing synthetic long stock? Well, there are some caveats to it, right? The caveats are different types of taxation potential. If you're doing something short term within 12 months, that's always going to be considered short-term capital gains. That's number one. Long calls and short put positions do not provide you with dividend payments if the security is paying those dividends, right? So you don't really benefit from dividend payments if there are any in the stock. There is a limited or a finite amount of time with an expiration selection on that strategy that you're picking, right? So if you're doing, short put long call in September or October, well, that's the amount of time that you're going to have long exposure for. Buying long stock, you can hold effectively if you're not leveraging, right? Forever. In the short stock position, if those of you who raised your hands, right, that there's some complexities here. Well, I mean, most of the securities and maybe at Fidelity would get a little spoiled in this sense. At least when I used to work on the trade desk, I know for a fact that I used to get clients that would call in wanting to short stock. They would call in and ask if Fidelity had any stock to short. And the answer for the majority of very liquid securities in the US was always yes. How many shares do you want, sir or lady, right? But that's not the case at every broker out there. So sometimes there's barriers to entry. You cannot find or locate stock to short. In that situation, you might want to consider doing a synthetic short position instead, right? You might not be comfortable with a synthetic short stock because, it could have an add-on requirement, unlimited potential loss, so forth and so on. But you could come up with a synthetic or a pseudo synthetic short stock position where your risk is still limited, right? If you're not doing just a naked short call, but you're maybe doing a short call spread to finance a downside put. So there's some nuance here, okay? So again, this is just the exact opposite view. What am I doing in the long stock position? I'm shorting a put and buying a call. So how do I create a short stock position? I'm long a call and short. I'm long a put and short a call. That's it. As simple as that. Now, the reason why I mentioned that I'm going to leave the more complicated stuff to Matt is because, Matt, we're at about halfway point here, and I just wanted to showcase the option chain to everybody and elaborate on the idea, right, of why these two, the short stock and long stock, are very important to understand. Is because anytime, how many of you in the audience, by the raise of hand or throw it into the comments, have heard systematic activity of dealers, of market makers? We are in a negative gamma environment. We're in a positive gamma environment, right? The systematic buyback of delta by dealers going into the monthly expiration cycle. How do Vanna and Charm components affect the systematic dealer buyback? So there are a few hands that are going up, and I do recognize the vast majority of the hands and the people who are raising them. Why? Because those people are participants in our volatility primers and all things volatility related classes, right? So folks, if what I just described to you, right, is completely new and nuanced, this is exactly the option synthetics is exactly what dealers are doing, what market makers are engaging in all the time, all day long, every second, every minute, every hour of a trading day. And this idea of, well, how do I create a long call position? So let's just, or a long stock position. Let me just go through this very quickly. So what would I do? I would be a buyer of a call option to create a long stock and a seller of a put. So right now, if I want to go and create a synthetic long stock, I have a negative carry, right? I have to pay around $4, $3.85 for it. Matt described the reason for negative carry being interest rates. So if I'm going out to September, 52 days out, because I can efficiently and dynamically engage in the derivatives market, and it doesn't require nearly as much capital as it would require for me to create 100 shares of stock long, which would be 54 grand. I can do it in the options market a lot more efficiently. I can use the remaining capital of 54,000, right? And I can invest it in the money market that is paying 5% annualized. So this interest rate that you can use, that you can generate on the additional capital, the market maker who is selling you this synthetic long, who's taking the exact opposite side, is doing what? They're buying a put and shorting a call. Now they're saying money costs money. If you're making this interest, right, on the capital that you're saving, and we're going to have to pay it because we're having to borrow capital in order to put on our position, why would we give it to you for free? That's nonsensical. So the market maker is basically saying, I am passing on to you the cost of my carry, of the opposite side of this position. If interest rates go to zero, cost of carry would go to zero. Now, their cost of carry, is substantially more efficient than ours as retail investors. You know, if I'm borrowing 54 grand at 12% at Fidelity, that's quite a hefty fee. They can probably borrow at a much cheaper rate. Um, they're closer, you know, to the prime rate, but it's still substantial. So they're going to be closer to 5% annualized, but with maybe a little bit of a tail, right? Now, Matt, again, this is so important to understand. And how does a market maker think? And what does a market maker do? I'm just going to kind of create the structure here. I'm going to eliminate these things out of here and create the structure that I just talked about. We'll just focus on one side of the equation, the long side of the equation together for just a moment. And I'll talk to you about the market making operation on the other side, so you can once and for all understand the subject thoroughly. And then we're going to start digging in deeper. Understanding the subject thoroughly is important because this is usually where the rubber meets the road. So if I'm a market maker and somebody is coming to me and I'm taking the opposite side of this trade, what do most market participants do in the S&P 500? They sell calls against their ownership of stock to generate additional yield, right? So they probably go out of the money and sell some calls on their SPY position. They say, you know, when things get kind of rocky and wonky, I want to be hedging my downside risk. So I will be a buyer of puts. So I'll sell some upside calls. I use that credit to finance my hedges on the downside. Okay, so that's what the vast majority of investors do when they're talking about the S&P 500, SPY, or SPX options. The dealer is on the opposite side of that trade. The dealer is synthetic long stock. Because why? Because if you're buying a put to protect your portfolio, they're selling you that put. And if you're selling a call against your stock, they're buying that call. Okay? So this would be a dealer position at the money. They're synthetically long 100 deltas of stock. They're effectively at the money flat gamma. They're positive theta a little bit, right? They're, you know, negative vega a little bit, but essentially all of these three Greeks got eliminated. I mean, they're frankly, they're zero. The fact that they're not zero has to do with the bid offer spreads and just pure market dynamics and semantics. So what is the dealer? They're long a lot of rho and they're long a lot of delta. So what does a dealer do? Well, if this is the position that is coming their way, in order to hedge themselves, and remember, they're passing on the cost of their carry to you, they sell short 103 shares of stock. Okay? So they sold short 103 shares of stock to offset their delta, and this is their net position. They don't have a position. Now, if the stock all of a sudden goes to 550, what happens? Well, their delta is still flat, right? If the stock goes to 530, their delta is flat. So they're short against the box effectively. If you kind of consider their position at all times and how this works out. Okay. Now the complexity again, Matt, comes from the point, and I'm not gonna, dive into the positive gamma, negative gamma schematics. But the reality is that nobody does, or not the vast majority of people don't come to market makers or don't come to the market. And they're like, let me just lay in, thousands of contracts of at the money synthetic short positions, right? I mean, why would they do that? They would sell out of the money calls and buy out of the money puts. And so those out of the money calls and puts have different deltas. But essentially, holistically, the market makers are on the other side of every trade that comes their way. And on the net basis, in the S&P 500, the market makers are short put, long call. Therefore, they're short stock against that position to decrease their delta exposure. They could care less which direction the underlying goes. Their number one job is to stay delta neutral and facilitate these transactions that come their way hundreds of thousands or millions of times as frequently as possible, create an efficient market, provide liquidity, take the opposite side of every trade that comes their way, and stay in business by getting flow from brokerage houses out there, right? So Matt, wanted to turn it over to you, sir, because now we're going to get into, some additional things of like, hey, if I understand how to create long stock or short stock, well, now what about if we start combining a stock position, long or short, with an option contract? So let's go through it, Matt. I have about 20 minutes, 21 minutes. I think this is plentiful.
Yeah, let me jump into it here. We joke that we usually don't get very many questions in this session, and that is not the case in this one. And we appreciate those and some really good questions coming through. Want to address a couple of them before I get into the new stuff because you joke there that you were leaving the hard stuff for me. I think that's about as complex as we usually get in this class when we're thinking about the market maker positioning. But let me answer a couple questions. First of all, can you just reset it for me really fast? So the first question stems from, well, why are we selling 103 shares, or not we, but the market maker instead of 100? And the reason why is because when you just add the deltas where they're currently sitting, they add up to positive 103. So to be completely delta neutral, you have to sell an additional 3 shares. And that's again a function, I believe, of the interest rate environment that we're in. If you were seeing something that was more flat, then those deltas would probably be closer to 50-50. And if they were identical 50-50, then you would just sell 100. But all don't care. They're looking at the delta and saying, okay, what's my net positive delta due to my options position? I want to take the opposite side. I'm going to sell however many deltas show up there. I'm going to sell the opposite amount in order to ensure that I'm flat. So that's where that's coming from. In addition to that, you mentioned the term short against the box. So back in the day, right? We're talking about way back in the day. There was a literal box where if you were short or if you own stock, you put it in an actual box at the end of the day. And if you were short, it's saying you were short against the box because you actually owed the box the certificates, right? So that's why they call it that. It's an antiquated term that comes from, I believe, the 20s, maybe is when they came up with that. But that's just basically another way of saying if I'm long 100 shares and I'm short 100 shares, it's said that you're short against the box because you effectively have no actual position, even though you have two that are showing up in a positions page.
That's right, Matt. And I just wanted to elaborate on this. We normally spend the vast majority of the time in the profit and loss calculator by looking through the view of the profit and loss diagram. But remember that you can switch it to a delta, right? Or a theta or a gamma and look at the relationship of your positions through the prism of what your Greek exposure is. So in the sense of delta, what I just did is I held down my control key, combined my 241 long and 241 short, and it's showing me, right, that I am long 102.59 deltas at the moment right here. So that's the reason why I'm shorting 103 deltas in order to delta neutralize myself. Now, obviously you could do a fractional share as well, but I doubt that a market maker would indulge in something like that or care about it.
Absolutely. So now that we've answered a couple of those, let me just answer one more quick one, and then I'll jump into some of these examples. And then I see one from Todd was asking about. I'm sorry, excuse me. Todd's asking about the efficiency. I want to answer that. And then Brian, I see your question regarding TDOC, and we'll jump into that a little bit here in a couple moments. But Todd was asking about the efficiency of this and non-margin versus margin. That is an important point. So one thing to note is when you're doing a synthetic long, in non-margin, one of the benefits of that is you're selling a cash covered put and you are actually able to get the interest, right? So when you sell a cash covered put, your money remains in the core account. So you're still actually benefiting from it being in there and you're still collecting a rate while you're actually still getting the long call and short put position. However, most people that are doing this are doing it on the margin side of the equation. And that's where the actual capital efficiency comes in from well, what else can I do with my money? Because instead of having to put that full, in this case of a put, you're setting aside $54,200 minus whatever premium you're collecting. That's what the cash covered put would be. On the margin side of the equation, it's going to be less than it. It's
Like about
comp
approximately roughly
20%.
25% of
Yeah,
that, right?
right.
Exactly.
And when you're doing it that way, basically what you're saying here is if I'm buying a call, selling a put, I'm getting that capital efficiency. What usually the person that's doing that, if you can figure a window to be bullish on this, well, you probably are bullish on something else as well. And you're thinking, well, I'm going to beat that 5% that I could get in the month or 2 months or 3 months that I'm putting on this synthetic long, right? That I think that's at least the mindset. Now, if you're picking the right thing or not, that's a completely different side of the equation. But that's the goal. It makes less sense in a non-margin account just because it's not really capitalizing on that capital efficiency that you can get on the margin side. And just to your point, Constantine, actually, I meant to show this when we were talking about the cost of the carry. It was a little bit cooler when you had your 386 up there. So I was taking some
There
of
you
the
go.
some of the numbers, right? And what we were looking at is $54,100. That's the amount that you'd have to set aside if you were just outright buying 100 shares of SPY at 55.41. So that comes out to 2705. Or excuse me, when you multiply it by 5%, I'm assuming a 5% interest rate here comes out to 2705, and then you multiply it by the days to expiration divided by the days in the year, and when you do that, what does it come out to? 385.369. So pretty impressive. It was amazing when you were looking at it. It was 386 a little
Yeah,
earlier.
and our differential, I think, in this market was a little bit more than $400. So,
Sure.
there you go. I mean, it's right on the money. So great work of the calculator there for sure, Matt.
There you go. There you go. So wanted to hit a couple of those things. And final one, and then I promise I'm going to get into the other stuff here. As far as the recording version of this, I looked on the website. I did not see a version of this class recorded, and the only way it would get recorded and put back on there is if we did one of these for a webinar. So these are coaching classes, not webinars. I doubt we'll probably do this as a coaching or excuse me, as a webinar, just due to the sophistication. We usually like to do a little bit simpler thing. So I don't think it's going to be on there. Unfortunately, I saw a couple questions on that, so wanted to address that really quickly. All right, back to this for a moment here. Not
Matt,
Yeah,
sorry about that, sir. I want to jump in here. Look, folks, I know that the slides, you want to kind of think about the slides. Understand that you can literally go into this tool and combine any two of the things, right? So we talk about, how do I create a long call strategy, which I'm pretty sure Matt is going to go to next because that's the one that most people do or most people engage in without even realizing that they engage in it. Okay. So how do I create a long call? You can literally put these simulated positions in your account, hold down the control key, combine the two legs, and you get the profit and loss diagram. I think this tool is invaluable in that sense relative to a slide, a PDF that you're going to probably, you know, throw in the trash in a couple days.
absolutely. And let's jump right into the long call because, as you said, that's probably the most common one that people are looking for. Maybe the put side, but definitely the call side. So first and foremost, what is the graph? And actually, let me close this again for a second. So what we're seeing here on the left hand side, once we go past our strike, it can't get worse for us, right? Whatever we ended up paying for this contract, that's the most that we're set to lose. We are paying, in fact, for the contract. So we need to overcome that in order to break even. That's represented by our black line. And then once we're past that, it's in theory infinite potential for it to go up. Now, It expires in 51 days, so it's not going to actually be an infinite number, but you get the point. If we go to 1,000, you're participating all the way up to 1,000. If we go to 2,000, you get that participation. So how do we make this from a stock and an option position together? Well, if we want the upside, and we can't use the long call because that's what we're trying to synthetically create here. So if we can't use that, if we're thinking about what's left on our board, short call, we know that's out. Put, now we want that to go down. Short put, potentially, but the problem is it's not infinite on the upside. It flattens out once we're past our strike. So that one's out. Well, long stock. Well, that looks good, right? On the right-hand side of our graph here, it continues to go higher as the underlying stock moves higher. So definitely want to incorporate that. But then what can we do? What would we do if we own stock and we were trying to protect ourselves to the downside, which is effectively what a long call is doing, is it's telling us, hey, I can't lose past what I'm paying for this. Well, if we owned long stock and we wanted to protect our downside, what most of you already know as the answer is, what if I bought a put? And that is the correct answer, because if you buy a put, depending on where you buy it, what strike price you buy it at, we know that you're protected past that point. Now, you're having to pay for that. In this particular case, this $10.65 is what you're paying for the put. The stock is the stock, but there's no extrinsic value associated with that. But what you'll notice here, we'll see that our break even here is 552.65. There is a small difference. When we go to this one, it's 556.65. Where do you think that difference is coming from? Well, again, it's the cost of the carry, right? The difference between the call price and the put price. In my example, I did it as exactly $4. So it's $400. And when we're looking at this versus this, oops, doing the wrong one, this and this one, we'll notice that it's exactly $400 lower as our break even. So that's still in play here. And that's why we spent so much time discussing that. But effectively, what we're getting is the exact same profile, risk reward, to the call by buying a put and buying 100 shares of stock. And we'll notice here, if we go to, we'll go right to where we're at 550. And let me reset this here. We'll go right to 550. And if we were to do this in real time, I mean, right this second, if we were to just snap up right to the 550 point, notice what our theoretical profit and loss would be on the call, 496.55. Notice what it is when we net these two positions out. It shows us right up here, 495.61. So it's the exact same thing. Now, it is important to note that if we were to go out into the future and let's say we were to get to September 20th and we were at the exact same price of 550, is that going to be the same thing? And the answer is no. And what you'll see is that in this particular case, we're actually losing $265 because we're underneath our break-even point. However, on the long call, notice that we've lost $665. And again, what is the difference there? It's 400. It's the exact same difference between what I paid for the call versus what I was able to sell the put for, or excuse me, in order to buy the put for. So that difference is going to show up as we get closer and closer to expiration. But you can see when we immediately put on the trade, if we were to have an immediate reaction or an immediate move, it would almost be identical in terms of its profit and loss. And the difference that we're seeing there, again, is represented by the cost of the carry. So
Matt,
that's
the important
yeah.
thing, right, is why is this a very common thing that we witness is because when people are really worried when stocks start to misbehave, when the market starts to misbehave, when it gets a lot more volatile, we get appointments, right, with people wanting to hedge their risk. And the first hedging strategy that people are aware of is like, well, if I'm not selling the security, if I'm not, tightening up my stop loss or stop limit, but I'm actually doing something in the derivatives market with it in order to protect myself from, let's say, a massive gap down, overnight risk, binary event type risk. That's the first thing they learn. Like, let me buy a put. And the point that we always try to make is that consider this. If you didn't own the stock right now, would you be buying a call option on this security that we're talking about? And most of the time, people say, what? Constantine, I think you're on the security, right? Without the realization that by buying a put on the stock that you own, you create a synthetic long call. And what is the outlook for a synthetic long call? What is an outlook for a call buyer? You are the most bullish that you could possibly be, right? You have capped amount of risk, but you also think the underlying is going up. So the reason why I always bring that question 360, full circle, is because if you're not bullish that security, right? If you truly think that security is going down in price, buying a put option for a hedge is not your trade. What you want to be doing is selling that security, okay?
Is where basically we are on the hook all the way down to zero. We have substantial possibility for loss in this strategy. And furthermore, we have capped gain. Once we're past our strike and we're above it, we can't make any additional dollars. Because if you had no position, oftentimes the answer is no. This is my favorite one for a different side of the equation, which is, well, what if we, instead of selling the put, what if we own 100 shares and then we sold a call against those shares? You'll notice that the graph at the top is
How many of
identical.
you in the audience have ever done a covered call before? By the raise of hand. Okay, so 20% plus, maybe close to 25% of the audience have done a covered call. So this is what Matt is illustrating. If you're long a stock and you're selling a call, and we're doing them at the money, normally you do a call out of the money, right? Because you want to give the stock a little bit of breathing room. But understand the core concept. At the same strike. So Matt, please take it away. I just wanted to engage the audience a little bit as we're wrapping up on time here. This is an important thing because this is what you're doing, folks. So let's go through it.
Exactly. And that's why it's so important to understand when you're going into a covered call, when you're selling calls against your shares, effectively what you're saying by doing that is that I'm willing to take on the same risk profile as a cash covered or a naked put, which is I'm giving away my upside. The best thing that can happen to my trade is we go beyond my strike. I collect the premium that I got for selling the call, or in this case, selling the put, and then I'm happy. I collect the premium. I move on to the next trade. What's the most common thing that we see though, Constantine? It's this. It's where we get to, I'm doing all these in September. We get to September 6th, let's say, and the stock is here. And the question is, how do I fix it? And the answer is, well, there's some things that you can do to defend it, roll it out, up, all sorts of different things. But at the end of the day, there's nothing to fix because this is exactly what you said you wanted to happen when you initiated the strategy. It doesn't feel like it because now you're looking at this and saying, wow, I sold this for, this premium here, but I could have made just $1,800 if I stuck to just owning the shares outright. But that's why I think this is also very helpful for people that are understanding or learning about option strategies is, well, if I'm okay with a covered call, I also have to be okay with selling a naked put or a cash covered put.
Let me put it
position.
in slightly different terms. How many of you in the audience have sold puts before? By the raise of hand. Okay, so again, 20+%. So if a put is worth 1 penny bid, 5 cents offered, and you sold it for whatever, $3, $4, $5, do you consider that a win? Do you celebrate? And what do you do if you see that your option is now, bidding 5 cents offered at 10 and you sold it for 5 originally? Well, hopefully you celebrate, right? Because you're sitting on a 99% profit and you're saying, that's great. That means that the security stayed above the strike that I sold. And what am I going to do with that capital? I'm just going to roll it out. I'm going to redeploy it in some shape or form, right? I'm going to redeploy that capital into a space where I can preferably make a similar type of a return for the risk that I originally took, right? That's what you would be doing. That makes a lot of sense. So to Matt's point, if you are long stock at 542 and you sold a 542 call and you brought in, $15 worth of premium for it, well, you have to realize that the maximum you can make is $1,500, right? No matter how high the security goes. So in other words, if come September 6th, if the security is at 560, you have all of this capital, 55 plus $1,000 of capital commitment, and that position is a way out of the money, right? An equivalent to a way out of the money 5 cent bid, 10 cent offered put option. What would you do in that scenario, right? Would you just keep that put and tie up all that capital? No, you're going to close this trade out and put something brand new on. And you're going to celebrate. You're going to say the maximum potential profit that I was capable of achieving in the strategy was achieved, therefore I should celebrate. Just like you would celebrate in a short put that is worthless. There are synthetically identical trades. They're synthetically equivalent if done at the same strike price. So if I'm selling an at-the-money call for a stock that I own, it's the same thing as me getting rid of the stock in my account and selling an at-the-money put. Same trade, synthetically equivalent. So again, it's something that happens all the time, but people doing synthetics don't even realize they're doing them. Helps you kind of think through the mechanics of what should I be doing, right? Should I be rolling out? Should I be closing? Should I be looking for a more efficient space to deploy my capital? How much of margin requirement do I have committed to this thing? Is there anything else that's option centric that I could make or lose? I mean, these things are massively important. Now, Matt, I'm going to be, I know that we're 2 minutes over. I'm going to be in the aftermarket briefing here, and we know that today is a huge day because AMD and Microsoft is reporting earnings. And Matt, I wanted to steal a screen, just quickly and ask you a question. And I've certainly been in those shoes before. I'm curious if you have been as well. Like, how many of you have been long a call option on a stock going into earnings, just an outright call or maybe a call spread or, some sort of a long delta with calls position? And you said, I'm seeing, let's say, Microsoft, and I'm not advocating for the fact that Microsoft is going to rip higher, but because I have no idea, truthfully, I don't know. It might as well be a 50-50 flip of a coin shot, which way it goes, right? It's not, a session about expected moves, buyers, of vol or sellers of vol, which makes more sense. But the idea is, if you did decide to buy a September at the money call option right now, you're saying, Microsoft is down 10, 15% off its high. I think it's down too much. I think it has the, possibility of going substantially higher from here. Let's say you're long a call option. And you'll look at the stock and the extended hours, like you're trading this option in your brokerage account with marginability and the ability to short if necessary. How many of you have been in the bind before where you're saying, if the options market were open and I saw, let's say the stock is up $50, right? I mean, that's a big move for Microsoft, like over 10%, but it's certainly plausible. You might be looking at something like that and saying, If the options market was open and the stock was at $470 in the after hours, I would sell my call so fast, right? I mean, I would be literally sitting on the offer with my call right now. Like I would want to be the first one in line to get out because I made my profit. I have no idea what's going to happen between now and the end of the extended hour session, what's going to happen overnight, what's going to happen in the morning, what's going to happen by the open, right? So we're just sitting there biting our nails saying, well, I hope it stays at 470 or goes higher by 9:30 the next morning. So how could you do something that basically neutralizes your position? So let's say it does go to 470 and we're not, talking about implied volatility dynamics. But if that was to happen and you could close your option, you would be looking at around $3,500 worth of profit that you paid $5,700 for. Notice that your delta has increased, right? With the move higher from 63 to 76. So what could you do potentially, right? To offset, to say, if the market was open, I would definitely get rid of my call position. What could you do? You could go in here and you can short some stock, just like a market maker would. Market maker would say, I made the profit that I wanted to make. I don't care what happens to this security from here on out. I've made my profit, $3,500. I'm happy with it. What I'm going to come in here and do is I'm going to short, let's call it whatever, 77 shares of stock at the price of $470. What happens in that circumstance? Notice I'm going to combine the two. So what have you done? You've neutralized your delta to zero. So if the stock goes up to 500, you don't make any more money. If it goes down to 300, you don't lose any more money. You've locked in your gain. Okay? Notice what happens. If the stock the next day opens at 400 and it's the following day, what am I looking at? Flat. Right? If it goes to 500, what am I looking at? Flat. I am locking in my 3,500 bucks of profit. And no matter which way it goes, I'm going to be flat that position. So what have I created here, folks? By doing this, what does this look like? I've created a synthetic long put, right? I've turned my long call into a long put position by shorting some stock after the stock is up $50. This is a very key concept. And again, definitely an advanced one for sure. But if you have the ability to do some of these things, and by the way, you don't have to short 77 shares, right? Like you could short less than that. You could say, I'll lock in some of the gains. Maybe you're saying I'll wait for the conference call. I have no idea what Satya Nadella is going to say. Maybe the stock goes even higher, right? If you're a little bit more bullish, maybe you'll short 25 shares or 30 or 40 or 50. Or if you want to be more bearish and you have the thought that maybe the stock actually will unwind more of that $50 gain, right? That happened pretty much instantaneously, a lot quicker. Maybe it comes in closer to flat. You can short more shares to become more delta negative, right? So there are all sorts of possibilities out there, and these things is something that you can do as a retail investor when the market is closed, then you can't do anything about your options position. Now, Matt, there's been about 150 times, I'm exaggerating, but certainly more than I could count on my hands, right? Where I was in the circumstance, and my followers know that Matt and I, and all of our other colleagues here on the desk are very limited in terms of what we can do. We can certainly buy stock and we can buy call options on stock if we want to, but we can't short stock, right? And we can't buy puts on stock. So there's been 1,000 times, right? Collectively, of all of us on the strategy desk being long calls, biting nails, saying, if they only understood that when we're shorting stock against the long call that's deep in the money, I'm really just flat delta. I'm not really being bearish, right? But maybe 100 years from now, the compliance teams change their mind and maybe attend a couple of synthetics classes by Matt and Constantine to figure that stuff out. All right, everybody, we'll wrap it up here. I will be in the aftermarket briefing with a few screenshots. Matt, last words to you, sir. This was an absolute pleasure, and
Yeah,
I know
I know
it's
you
it's a
gotta.
complicated topic, but
It
you're
is,
you're
it
a great
is.
coach, sir.
And we could probably go on for another hour or two about this. I know you got to run, so feel free to hop out because I know you got to get some things ready. I was going to answer a couple questions that came through here, but you can start to see it. I know Constantine's example was focused on the what if I bought calls going into the earnings and it goes up. Well, what about the opposite? What if you bought puts thinking that's going to go down? I mean, the opposite situation is true. Sometimes the initial reaction is very, very poor to the downside, and then before all is said and done, we're back to even by the morning, or we've even rallied back the other direction, and we're positive. You can do the same thing, but rather than, right, if we're going out there and we're long puts, what does that actually mean? Let me go back to my SPY example, maybe, so everybody sees it. If we're long puts in this example, well, we're actually negative delta, so we'd be buying back shares rather than selling them in order to be able to flatten out some or all of that position if you wanted to. Let me hit a couple of these questions that came through and then we'll wrap it up. Wayne was asking about, what options trading strategies would you suggest that we master? So that's the thing about the strategies. I don't think of them as there's one that's better than the other. I saw something about, different strikes. What's the best strike for a synthetic combination? It's not that one is better than the other. It's about matching the strategy to your outlook. Are you actually doing or expressing your outlook appropriately with your strategy? So I think of it more like putting tools in a toolbox. There's times where calls are going to make sense. There's times where puts are going to make sense. There's times where there's spreads and diagonals and condors. I mean, they all have their place and time depending on the environment and, more importantly, the outlook that you're trying to express. So I think that, if I had to answer your question and the way that you framed it, which is fair, I'm not trying to criticize the framing of the question here, but I just like to give you my perspective on how I think about it. But if I try to answer it in your version, start with the simple: do I understand the basics of single leg buying a call, buying a put, selling a call, selling a put? Do I understand where the environments for those individually make sense? And then you want to start adding in legs. I want some strategies that are good for low volatility environments. I want some that are good for high volatility environments. Is there a skew difference between this month and the next month where I'm trying to capture that volatility difference? So, there's all sorts of different things out there. I also think it depends on what kind of trader you're trying to be. Are you trying to be a short volatility capture theta type of trader, or are you trying to be more directional? If you're directional, then you don't really need to waste time with calendar spreads, because basically that's a neutral based strategy. So try to think about, well, what kind of trader do I want to be, and then what strategies go with that style of trading? That would be how I would answer that question. um Todd, you were asking about how do we do these just in general on one trade ticket. Let me show that really, really fast. So if we go to multi-leg options trade right here, and then what you want to do is actually, if you go to combo, and let's say we just wanted to do SPY, I'll just use August 16th so I don't have to keep scrolling down here. And we wanted to do the, exact at the money version. You do it just like this, and it actually pre-fills the buy to open and sell to open portion for you. And you'll see if you did this right now, it'd be going for roughly $1 on this particular trade if you were doing it on SPY. So you have to use the combo for these long synthetic stocks and short synthetic stock trades. So how does this approach differ than the poor man's covered call. So the poor man's covered call is incorporating these concepts in there. The main difference between a poor man's covered call and a regular one is you're just substituting the long shares with a deep in the money option. Sometimes it's a leap, sometimes it's just a couple months out. It's the same idea though. And when you're thinking about it, what you'll hopefully understand after this class is the poor man's covered call is actually the same thing as selling a put. It's a little different because you have two different dates in there. So there's a volatility component that you're trying to capture. So it's not as one to one as going out there and using the same dates. But it's generally speaking, it's just another version of selling a put. What would typically be the expiration dates used on the puts and calls? So if you're trying to do a true synthetic, you're keeping those generally speaking on the same date, right? Because again, just like with the poor man's covered call, when you start using different dates, you're introducing some other aspects. There's differences in the theta decay, so you're trading time. There's differences in the volatility, so you're also trading volatility. It's not that those completely go away when we're incorporating these, but as you can see, when we're using the same date and we have it go to 550, well, the profits and losses are going to be effectively right there knocking on the door of one another when we're comparing that versus this and this. Sorry, did the wrong one. This and this one and that one. There we go. 801. Brian, let me talk to your example here for a second because he was talking about doing one where he was looking at TDOC, and you brought up a good point. I saw your clarification about how it's not liquid, and they're not terrible, honestly. When you go out, I mean, 5-point spread, 6-point spreads, a little thin on the volume and open interest, but I mean, it's a little bit suspect. It's not the worst I've ever seen. It's not great either, and it could potentially go away. But I wanted to illustrate the idea of thinking about it from the perspective of just doing the long and short. And let me do an example. What if I just wanted to be long and short here? And you can see this one's a lot flatter when we talk about the cost of the calls versus the cost of the puts. You can see at this one, we might even be able to do this at a credit. It's hard to know exactly where the market maker would fill our trade, but you can see at worst, we should expect probably to just pay a penny to put this on. So it's very, very close. And when that's the case, it's going to be effectively the same as going out there and getting the shares at whatever price they're currently at. One alternative thing that I wanted to throw in there, which we didn't really even get to, we do a whole class on this, but it's the idea of now that we know what a synthetic long position is, well, what if we wanted to be a little bit more creative in our strike selection? And we wanted to start doing some things that weren't necessarily one-to-one, meaning the strikes weren't the same. So what if we started to structure it something like this? For example, you could sell a 7.5 put, buy a 15 call, and you can collect a credit. So worst case scenario, not worst case scenario, but where we're still making maximum gain, as long as the stock stays above 7.5 by January 17th, we're making whatever our credit it was. And if it goes higher, then we still have that potential for upside. But you can see there's a flat spot here between our break even at 737 and then our strike price. So this is flat at expiration, but you can see it's theoretically still unlimited to the upside. And we could, do it in a way where maybe we're paying a small debit. In this case, I did it at 29 cents, but we're dragging down our strike to 12.5. And it's, somewhat similar here. The main difference on this one is it can't just stay above 7.5. It needs to go up, right? We have to go up above our short strike, or excuse me, our 12.5 strike by whatever we paid. In this case, it's 29 cents in order to break even, which is why this structure, a lot of people prefer this one from the perspective of, well, I have some level on my chart. I don't think it's possible breaking that. Be very advised it absolutely can break that. So be aware that just because you think it's an important level that can't be broken, it definitely can. But a lot of people get in their heads that, oh, I have some level that can't be broken. I want to sell there and I want to buy an option that is at least that price or less. And therefore I have, somewhat of a free trade. And if it goes haywire and it goes, massively to the upside, I'm still participating. I get the allure of the trade. I mean, if that's what actually ends up happening, it makes perfect sense. The problem is, what if we don't go there. What if we went up to 14? Well, guess what? At 14 by expiration, we only made $13 on this trade. If you just went out there and bought 100 shares, which I didn't even include that on here. Let me add that in. We just bought 100 shares of the stock at the current price. Are we making $13? And the answer is no, we're making 425. So there's, risk reward trade-offs here. I mean, the good news on our structure is, what if we go to 780? Well, we've lost 195, or, a decent chunk of our basis. Whereas in this particular structure, again, we've still made $13 at expiration. So there's a lot of different ways to structure this. This one, what if we do something like we go up to 13? Well, in this one, we're actually making a little bit more money. It's not a ton, but it's 21. Again, in this version, we've only made $13 on this potential trade. So a lot of different ways to structure it. It's just a matter of, basically when you go in there and start doing the math, you're going to realize that a lot of these things are going to come out pretty closely. It's the question of, do I think I can do better? Because if you're just leaving it in the money market versus, getting the capital efficiency, the question is, if you do it this way versus buying the stock, can I do something that is going to make more than what I could make in the money market? That's the real question that you're trying to ask yourself. All right. Cliff, yeah, I saw you said you just did a covered call. I'm not knocking the covered call. Sometimes it makes perfect sense. There's a lot of situations where the covered call short puts, they're the perfect strategy. It's just understand when you're getting into a position like that, does it actually make sense? Because I think the stock can double or go up 20-25%. If you're selling a call that's 5% out of the money, why would you do that? You're giving up a lot of potential upside, and you're going to not like yourself if it ends up doing what you think it's going to do. Let's see. I think that's about it. Yeah. I think this is last one. So last question, is there a benefit to buying a call in cash and selling a naked put on margin for the bullish strat? So I don't really know why one would buy a call in cash and try to leave it there. I mean, if you have margin, the system will automatically try to move it over to the margin side anyways. It doesn't mean that you're using borrowed money to pay for the call, but you hold both of them on the margin side if you had it. Again, the best way to answer that question is, are you trying to do something with the cash that you're saving by doing the synthetic version rather than buying the shares? And will that beat whatever rate that you can get in the money market? If the answer is yes, if you think that exists, then the synthetic version is usually the more attractive one versus buying the shares. But just note, again, the difference is due to the rate. If you actually just went out and bought the shares versus you did the synthetic, most of the synthetic at the monies right now, you're paying more for the call than the put. So it actually does need to go up for you to break even, whereas that's not going to be the case on the individual stock. But again, that's because it's assuming the option market is assuming that the capital that you're saving is going into something that's yielding the risk-free rate. If you can do something better than that, then the synthetic suddenly becomes a little bit more attractive. All right. With that being said, that was all the questions. Thanks for sticking around a little extra if you did. Hopefully everybody enjoyed it, and we will see everybody next time.